Guys, the Nasdaq is in correction territory, still down almost 13% from its all-time high of 20,204. Is this the start of a big bear market, or is this an opportunity, and one of the best opportunities we've seen in a while, to buy some great names at discounts? Now remember, I want everybody to remember this. Just because something is cheaper does not mean it's cheap. Just because something's a better value does not mean it's a good value. There's a big difference. Example I always give is, let's say your house is worth $500,000 and you ask $5 million. It's going to sit there. If you discount it in half to 2.5, is it cheaper? Yes. Is it cheap? No. Still overpriced. We've got to remember this. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. Now, the Magnificent Seven alone is down 14% since the start of the year. It's down almost 20% from its high this year. That's a big drop. Now, remember what we said. We always said on this channel and our main channel that the stocks that drive up the indexes and the indices will be the ones that drag it down. Even today, the Nasdaq was up 0.8%, literally when I started this video. Now it's down 0.2%. Big fluctuations, a lot of volatility in the market. The volatility index is absolutely skyrocketing. So where do we stand in terms of values? Guys, this is the stock market to GDP ratio. This is yesterday. I put this in yesterday after the big drop in the Nasdaq and the S&P. We're still 100% overvalued. Based on history, we're still 100% overvalued. Now, does that mean that things aren't going to get better and they can't get better? No, of course they can get better. They can get a lot better. Fundamentals can get a ton better. I thought the markets were overvalued in 2021 and 22, but fundamentals got better. GDP started to really skyrocket. Look at this. Back in June of 2020, GDP was $19.6 trillion. It's currently 29.7. That's an increase of 50%. When you have that big increase, you're going to see the same increase in terms of fair value. Look at fair value in the S&P back then, 1860 to 2816. This repeats over and over that if you're not like me, I have 1,000 apartments. I have 7 or 8 businesses upstairs. I have multiple ways of generating cash flow. I'm not Berkshire Hathaway, but in my own essence, I kind of am. I don't need to go invest in the markets at all times. I will do just fine making 4 or 5% a year. But guess what? Even being out of the market for big chunks of time, I've still grown faster than that because of my real estate and my businesses. But for you, who are saving for retirement, putting your money in your 401k or IRA, you need to dollar cost average because you have no idea when the market's going to bottom. But the reason we dollar cost averages, this is the market's value over time. And this is what the price does. Sometimes you'll overpay, sometimes you'll underpay, but you'll match that market all along the way. Now, guys, some companies are reporting this week. There's a lot of data coming out. CPI is coming out. Guys, the markets really want to react to every small thing that happens. But remember, guys, in the history of the stock market, let's think about all the things that have happened. Let me show you. This is going back to 1950, guys. Look at this is even everything that happened. This is a small sample size of all the things that happened in our country. Forget about the world, all these things, and markets still went up. Why? Because as economies get better, companies within that economy have to get better along with it. So if you're betting on the future of America, as Warren Buffett says, you bet in the S&P. Doesn't mean that today's values make sense, but your job is not to guess when values are too high or too low. Don't make that same mistake that I made. Do I regret it? Yeah, essentially I do, of course, regret it. But again, I don't need the numbers. I don't need to have my money invested to be great. In fact, when I do my financial things, my cash in my hand, I assume that I'm going to make 3% a year for the next 5 years. That's my assumptions. And then from there, I'm going to match the market. That's it. That's all I'm looking to. That's what I do my assumptions based on. That doesn't include my real estate, doesn't include my businesses. That's my point to you guys. You got to remember that you're here to save for retirement. The further out you have to retire, the better off you're going to be. 40 years ago, if you're 25 and you're retiring at 65, 40 years ago, this is where the S&P was. The S&P 40 years ago was at about 200, give or take. Now it's at 5,600, 28 times your money. And in that time frame, look at all the things that happened in that time frame and more. That's the thing you got to remember. This is to be repeated over and over again, guys. You know why? Because I do the same thing. Investing is simple, not easy. Stick to what works. Stick to the things that make sense. Look at the long run. When you repeat these same basic tenets over and over again, you're going to do extremely well. And again, guys, look at this. Look at the volatility here. And now the Nasdaq's up 0.5%. So in this video time, in the 10 minutes we've done it, it's been up 0.8%, down 0.2%, up 0.5%. That is a 1.5% swing in a matter of 10 minutes. I don't know what that means. All I know is that valuations are very high by most reliable, actually by all reliable metrics. And that just means one thing. Be ready for a lot of choppiness and probably not great returns for the next 5 or 10 years. But if you buy as things look worse, you will be able to dollar cost average, because in March of 2000, the peak of the peak of the Nasdaq, if you'd started dollar cost averaging then, you'd have seen your money fall 83%. And to this day, you would have still made almost 15% annualized returns, which is incredible. So guys, if you like this, do me a favor. Look for the community. We're looking for great like-minded investors. We're not looking for people who want shortcuts. If you're that kind of person, please stay away. Don't ruin the group that we have.